For the time being, let's focus on the cement space because we saw a big rally play out on several cement stocks yesterday. A couple of buy notes coming in from some of the brokerages. So what is the overall perspective looking like as we step into the new year? Centrum Broking has written a note on the sector where channel checks are indicating that downward price trends could continue for the cement sector, at least in the near term. Mahesh Badang, Senior Vice President Research at Centrum, is with us now. Mahesh, good morning. Good to have you with us on the show. So let's just get the pricing picture out of the way. Can you elaborate on this? Where do you see this price pressure and will it persist even as we get into the final quarter of the year?
Hi, good morning and thanks for having me. So we have done a recent channel check, and in the month of December, we have seen almost 2% month-on-month decline in pricing across the regions. And this is the second month wherein there has been a decline. But just to give a background, the industry had taken a very large price hike in the month of September and October. And with demand not persisting, there has been this rollback. So we are back to the levels that we were at, just before the September levels. And overall demand, I think, is down because of multiple reasons that we've had, state elections in 4 to 5 states. Then there has been some rains in some of the southern parts. And overall festive season and winter season in north is also impacting demand. So with this background, I think the decline was warranted. It has happened. And as we go into the fourth quarter, I think what is going to be interesting is that what is the impact of general elections. So typically we would see some slowdown, and government's endeavor has been to complete most of the projects before the election. So probably just a couple of months before when the code of conduct sets in, and 2 or 3 months afterwards, we should see some slowdown in demand, which could keep pricing under pressure in our view. So at least the channel check is suggesting that the demand has been sluggish across. Rural demand has not picked up. I don't think infra is driving it. And as a result, the cement prices have corrected.
Mahesh, morning. So if cement demand is subdued, prices have come down for the second consecutive month. Is there any risk to earnings expectations for any of the cement companies? Are we likely to see a bit of a negative surprise in Q3?
No, so Q3, what we are building in right now is that for the sector, we should be able to see at least 140 to 150 rupees improvement in EBITDA per ton. So despite the fall in the last 2 months, the QOQ average prices are still up by 2 to 2.2%. And here, what we are expecting is that at least 140 rupees to 150 rupees improvement should be there. At least for the time being, I don't see any risk to my FY24 and FY25 estimates for the company.
Okay, so maybe not now, but what about margins? And, just run us through how the raw material picture is also shaping up, because as you're saying, clearly there's unlikely to be a major price revision on the upside. What about margins given the input scenario then?
Yes, so we should see some decline in power and fuel cost because the coal as well as the petcoke prices were trending down. And compared to last quarter, I think at least 10% decline on rupees per kcal basis should be there for power and fuel cost. So what we are building in is at least 80 to 90 rupees as relief from lower power and fuel cost. But with busy season surcharge coming in, freight should be up. So overall impact reduction in power and fuel cost for the sector should be to the tune of say around 70 to 80 rupees.
And just looking at, from a 3-year point of view, yesterday we had a Nomura report which said that the cement volume growth in the next 3 years, FY, I think 24 or FY25 to FY28, will be at 5%, which is higher than the volume growth that we've seen in the prior decade at 4%. Would you want to comment on that and even on how capacities are coming on stream? Because I was seeing a Fitch note where they're saying that annual new cement capacity addition in India is likely to double over the next 5 years, but steady demand growth will help maintain the industry's capacity utilization. So talk a little bit about the big picture.
So when it comes to demand growth, our view is that at least cement demand growth should be in line with the GDP growth. So 5% seems slightly lower. And in the past 3 years, we've had a double-digit demand growth. So every year, almost more than 10% growth has been there, which is, and even in this year, FY24, almost 10% demand growth is expected. So on this 3 years of very high growth, I think there should be some moderation in 25. And 26 onwards, we would go back to the growth which is in line with GDP or 1.1x of GDP growth. That's on the demand. In terms of supply, obviously most of the companies have given very ambitious and optimistic targets on capacity addition. And recently, Mr. Puneet Dalmia gave an interview wherein he mentioned that he expects the capacity to or the incremental supply to outstrip the demand. So we also we also think that the similar situation should arise, that incremental supply coming into the system is higher than the incremental demand. So even though demand is probably going to grow at say 6%, higher pace of supply should actually keep utilization slightly lower. So you will hover around 72% utilization rates.
Okay, thank you very much for that.